Hi, good afternoon, everybody. Thank you for joining us for our 5th annual Integration Symposium. Today's session is about one of my favorite topics, trade and investment. And so it is a real pleasure to have two very dynamic speakers for you all today. Before that, if this is the first time joining us, welcome to the SMU Mission Foods Texas-Mexico Center. Our whole reason to exist is to explore the dynamic economic, political, and social relationship between Texas and Mexico. Its #1 trading partner, by the way. Today, I am joined by some great colleagues here at SMU and an institution. I know a board member is joining us, Jean Tower Cox. Jean, thank you for being here with us. From our faculty advisory board, we've got Dr. Livy Russ. Thank you, Livy. Partner in crime and great friend, and I would say one of our #1 champions, Jim Hollifield, and our non-resident senior fellow, member of faculty board, and an all-around rock star, Pia Orenius. Thank you all for joining us, and then nothing would happen in this institution and at the Texas-Mexico Center without my colleague, Jennifer Aperti. So Jenny, thank you so much for everything you do. I get the pleasure of being the executive director of the Texas-Mexico Center and telling you more about our prestigious speakers. First and foremost, Dr. Raymond Robertson. He's our senior fellow, member of our faculty board. He's also a professor and holder of the Helen and Roy Root Chair in Economics and Government in the Department of International Affairs at the Bush School of Government and Public Service at Texas A&M. He is also the director of the Mosbacher Institute for Trade, Economics, and Public Policy. He's a research fellow at the Institute for Study of Labor in Bonn, Germany, and our senior fellow. He was named in 2018 the Presidential Impact Fellow by Texas A&M University. Thank you, Raymond, for always being just such a great messenger for some of the best research out there. He will be joined, and here this new thing that we're bringing policymakers and business people to respond to our research is Mr. Fernando Sepulveda. Fernando is the founding partner and CEO of Grupo Impulsa. It's a business development ecosystem composed of 3 different organizations within it. An incubadora, de Negocios Impulsa, an accelerator, de Negocios Impulsa, and Filantropía, a nonprofit organization focused on social enterprises. So thank you so much, both of you, for joining us. Dr. Robertson will frame the conversation. And for anybody who wants to ask questions, please use the Q&A format, and I will pull questions for the discussion after their presentation. Raymond, take it away.
Thank you very much, Luisa, for the generous introduction. It's such an honor to be working with you as always, and the important work that the Texas-Mexico Center has done and continues to do is so critical right now because of the economic recovery we're experiencing, but also we're in the middle of a very fundamental shift in trade for a number of reasons. What we've seen is growing resistance to trade for the last decade, more or less. We've seen rising costs, we've seen congestion in supply chains. We've also have seen inflation in supply chain costs. We've seen trade policies and a call for reshoring, especially coming back from China. So what I wanted to do today to really have this opportunity to pitch to you this idea that now is the point in time where we should redouble down on our efforts for North American economic integration. The comparative advantages that North America offers vis-a-vis the rest of the world are still significant. And I think that the trade war actually opens the door. The trade war between the United States and China opens the door for a deeper integration. And so what I'd like to do today is share with you some of the research I've been doing that highlights, how that relationship has manifested throughout the trade war, if that's all right. With your permission, I'd like to go ahead and share my screen. And we're going to start with this slide, which is looking at the US-China trade war and Mexican exports. This is work that I'd like to highlight as being done with a student at the Bush School, Nereda Ortiz, who's one of our stars. She's actually was a fellow at the Texas-Mexico Center last year as a student intern, and she's been working on this as well. So I want to make sure she gets all the credit for this. But just to give you an idea, as I mentioned in my opening comments, that the United States is really at this critical point and is going through a major transition. You might remember, some of you who are a little older and have been paying attention longer, remember that China joined the WTO, the World Trade Organization, in 2001. And just in the last couple of years, I published a paper that looked at how the rise of China's trade actually affected Mexico and Mexican workers by competition in the US market. And the main focus of that research was really on apparel, because one of the big concerns at the time was that with China's growth, China became the significant apparel producer in the world, displacing Mexico significantly in the US market. And we showed that this has really negative, significant effects on wages and employment on workers in Mexico. So the point that I'd like to highlight from that work is that competition in the US market between Mexico and China back in 2001 and the early 2000s was really more in these labor intensive goods, right? So now we're in 2018, now we have a trade war between the United States and China. And I think a lot of people are wondering about, did production shift back? And most people understand that it has to some degree, but then what kind of products shifted the most? And so I'd like to argue that the shift that we've seen as a result or following the trade war actually demonstrates a new paradigm for North American integration. And I'll suggest some ways that we might capitalize that to address on some other pressing social issues that we're facing. And as you all know, China and Mexico have had very different rates of economic growth. So the solid line in the middle is China's GDP per capita in 2010 constant dollars. And then you see that there's this gap has been closing between the China and Mexican economy, the Chinese and Mexican economy. Mexico hasn't been growing as much. It has been growing a little bit more since, over the last decade, but obviously not nearly as much as China. So one of the concerns that people had when they looked at this graph was, well, Mexico's GDP per capita hasn't changed that much. So since China's really advanced a lot, does this mean that some of those labor intensive goods like clothing or apparel are going to shift back to Mexico as a result? Well, let's go ahead and kind of set the stage by looking at the trade war. This is US and China tariffs. So the blue line here in the middle is the US tariffs on Chinese exports. As all of you are very, very familiar, back in the last presidential administration, President Trump was very aggressive in imposing tariffs on China for a number of reasons and in a number of ways, and imposed a very long list of tariffs on Chinese goods. As a matter of fact, close to 94% of the 4-digit HS categories had tariffs on them, so in some form or another. So it was really a significant push of tariffs towards China. China, of course, retaliates, and you see the red line is China's tariffs on US imports. And these obviously stand out from tariffs that were on the rest of the world. So this is what we mean when we say the China-US trade war. These, of course, have leveled off. We're waiting to see what the new administration is going to do with some of these tariffs. It's not clear that the tariffs are necessarily going to come down. So the question is, this is a very sharp increase in tariffs. So did this change induce the shift in imports from China towards Mexico? So one way to look at that, just through some really simple summary statistics, is to just look at US exports to China and then US exports to Mexico, and of course the imports from China and the imports from Mexico. And one of the things that you'll notice right away is obviously the Chinese economy is very large, and the United States imports a lot from China. I mean, they're far and away larger than our imports from Mexico. And then you also see this consistent rise from 2009, obviously sort of in the middle. The beginning of the Trump administration, there was a decline, but then they rose again. And then starting around 2018, right when those tariffs spiked, we saw a decrease in the imports from China. And so this is economics 101. The whole point of tariffs, of course, is to reduce your imports. And in the short run, tariffs can reduce imports. And so it's not surprising at all to see that the tariffs were followed by a reduction. Now, if you look at the US imports from Mexico, though, some curious things happen here, right? Is that we start seeing sort of a significant increase right around 2016 that actually coincides with the strong rhetoric of the Trump administration. So the Trump administration was basically predicting some of these tariffs, and so there was some anticipation, and we already saw exports from Mexico to the United States start to rise. And the question here is kind of what happens in this 2019-2020 period. Obviously in 2020 was an economic setback, to put it mildly. So we did see kind of a downturn in most places. But nevertheless, right, we're focusing on this period about which goods and which products kind of made up for this gap, and which products were the ones that would change the most. Okay, so the theory, obviously, I don't really need to present theory to this audience, right? But the whole idea is very simple, that you're imposing the tariffs and that's going to raise the cost of Chinese imports. But the critical thing here, and I could go in, obviously, if you want to talk about this in more detail, but as a card-carrying economist, I'm required to present some theory, so I apologize to you all in advance. But the idea here, right, is that in a two-dimensional world, clearly the increase in the costs of Chinese imports are going to reduce those, but then this particular figure demonstrates that there's going to be a substitution towards somewhere else, right? And so the theory is very clear that the imposition of tariffs doesn't just reduce the overall imports, right? That buyers and consumers and businesses are going to look for another place for those. And the reason why we mentioned that substitution effect is, you might remember back in the Trump administration, he was really, really concerned about the trade deficit and saying that, you know, the trade deficit is harmful. And the point of the theory here is that the tariffs are not necessarily going to address the deficit per se, because you reduce imports from one country, you just increase imports from another country. And so the overall deficit doesn't change, and tariffs are probably not the best tool to use to address any kind of concerns that you have about the trade deficit. There's other concerns about tariffs and the trade deficit, but maybe we could talk about those in the discussion. So what kind of empirical analysis do we do? So we carry out what's called a panel data analysis. We use monthly data of US imports by industry at the 4-digit harmonized system code. We're using data from January 2009 through December 2020. And we wanted to break this down with 4 major regions. Obviously, Mexico and China are leading, but Vietnam is another one. And the reason why we included Vietnam, partially because we're kind of curious about Vietnam, but also there's been a number of scholars which have suggested that the competition now for Mexican exports is really not China as much, or maybe it is, but also Vietnam is also emerging as a very prominent player. Now, the reason why Vietnam is particularly interesting, right, because Vietnam is a country that clearly exports those labor-intensive goods. So they're grabbing a much larger share of the US apparel market. And so we were just kind of curious about whether or not some of the, like apparel, for example, or a labor-abundant country might be picking up some of those exports. And then we actually incorporate tariffs. We're going to use the tariffs aggregate up to that 4-digit level, but we get those from the USTR. We combine those into a panel data analysis, and we run a bunch of regressions. The regressions that we're doing are really, and I'm going to go ahead and show you the fancy stuff first, and then I'll show you the simple stuff later. But the idea here was to estimate that elasticity of substitution between the Chinese and the Mexican exports in the US market. And the idea there was the elasticity of substitutions, a fancy economics term that basically represents the percent change in the imports from Mexico as the result of a percent change in the exports from China, right? And part of the identifying assumption that we're relying on here, and you might quibble with this later, some of the people in the chat, maybe Pia or Jim or somebody, is we're assuming basically that the Chinese imports are really going to be driving Mexican exports and not the other way around. So, and I think that's relatively valid given the relative sizes. We do a bunch of vector autoregressions, and we kind of show some support for kind of a causal relationship that goes more towards China and the tariffs driving the Mexican exports rather than the Mexican exports driving sort of this relationship. In other words, we're assuming that it's not some kind of growth in Mexico that is causing the reduction in the Chinese exports, okay? It's the tariffs affecting China, then that switches over to Mexico. Now, one of the interesting things is when you estimate that elasticity, we look at some of these industries that show up are really kind of interesting. They're not ones you usually would think about. These are the ones that end up changing kind of the most as a result of these tariffs in the regression framework and that elasticity parameter. And some of those are like milling products. You got malt, starch, insulins, or whatever. Cereals are another one. And what we're looking at is very large numbers in this column over here. These large negative numbers represent kind of that elasticity after the tariffs. And this is the elasticities actually really get a lot bigger after the tariffs. Some of these miscellaneous edible preparations actually go from a positive relationship where Chinese and Mexican exports actually were positively related, and they switch over to a negative relationship after the tariffs. And then you look at some of these other things, rare earth materials, of course, goes from a positive relationship to a negative relationship. And these modified starches and glues and enzymes switch from a positive relationship to a negative relationship. The reason why that switch from a positive to negative relationship is so important is because this represents a real substitution from markets and represents real a fundamental change in the production relationship that occurs basically in a whole bunch of these different industries. We sort of just picked out examples to show you that transition, but it happens in a lot of them. If you look at sort of this distribution of results of these individual elasticities, the substitution elasticities, this is kind of the distribution. Like you think of this as a continuous histogram, if you're kind of familiar with statistics. And it shows that, obviously there's a bunch of goods that have a positive relationship, that Mexican and Chinese exports kind of move positively together. So they might be linked in a positive way. But then the ones on the other side are the negative relationships, which show that they're more substitutes or they're competing in the US market. The key thing here is that when you compare the blue line to the red line, is that the red line pre-tariffs, you see these spikes over here, which shows that there's this kind of more prevalence of these positive relationships. And then after the tariffs, they shift over and you get spikes over here in the blue line on the negative side. So again, my point here, just to put it in the simplest interpretation, is that we do see evidence of a fundamental transformation in production relationships where the Mexican goods become much more competitive with the Chinese goods, okay? So that's really important. So then the next question is, okay, well, which, Professor Robertson, enough of that, fancy stuff, just which goods are the ones that we really are seeing the largest changes in? Here is the a scatter plot, what we call, of the change in Mexican exports on the y-axis, pre and post tariffs, and then the change in the Chinese exports pre and post tariffs. And so this is at the 4-digit HS level. And basically you see it's just a big mess, right? That in each one of these quadrants, you can see kind of this relationship. Over here is when they both increased, both Chinese and Mexican products both increased relative to like 2 years before the tariffs. And then here they both decreased, and there's a lot of industries here. And then these are a bunch of very weird ones where actually there was a lot of industries in which actually Chinese exports increased while Mexican exports decreased following the tariffs. And then these red dots here, and I'm going to get to this other quadrant, I'm not limiting it, but the red pluses here are the very few goods with no tariffs, and you don't really see kind of much of a relationship there. But what you do see is that many, many more of the products had tariffs on them. And we're going to focus particularly on this quadrant here, because this quadrant here is the one that shows industries that had significant increases in Mexican exports while the Chinese exports decreased. And so my question here is, which ones are these? Are these the labor intensive goods? Does this represent a reshoring of that apparel production that we lost in the beginning? Or what are these goods that actually seem to have responded the most? So in order to highlight that, what I did was I'm going to present a graph that just focuses on this quadrant. And I labeled the main industries. So here's a bunch of ones that had kind of smaller responses, and I couldn't label all of those because there's too many of them. So here are the ones that really changed the most. And what we see is steel, iron, railway service vehicles and cars. So this is, and obviously some of the agricultural stuff, you have soy, you have raw materials, the manganese, and then wool and silk. But the thing that's interesting about these, especially with the iron, the steel, the manganese, and the railway service cars, is that most of these goods are highly capital intensive goods. These are the kind of advanced manufacturing that represent a very developed economy. And so my main message here is that between 2000 and 2020, the Mexican economy has undergone a dramatic transformation from being sort of this labor abundant, assembly based economy towards much more high tech, whether it's automobiles, as we all know. But now we're producing Mexico is producing the heavy industry, the very more technologically sophisticated goods that was kind of the aspiration in the 1950s. So because of that production relationship, this opens up many, many new doors. If you actually just kind of, right, so look, here's steel here, and some of these new doors, is that since kind of the imposition of these tariffs kind of starting in 2018, these are Chinese exports. You see a decline right here in the steel and obviously the different kinds of steel. The reason why I point this out, though, is that I want to keep you all interested in what's going to happen, in the next couple of months, because already looking into January, we see sort of a rebound in steel. And so we don't really know whether or not these changes in the production relationships that we've seen are permanent. And my point is that before we give them a chance to maybe revert or recover, now is the time for policymakers to intervene and make the kinds of investments that would secure this production in Mexico so that we don't lose it again, because keeping it here in North America in particular is going to be beneficial for the United States in a number of ways. Okay, so as I said, I mean, Mexico is offering significant advantages, especially in response to shipping costs. And I wake up in the morning and I check kind of the supply chain news. I'm sorry, it's kind of embarrassing. I always check the supply chain news. And one of the things that came out yesterday was that supply chain inflation is increasing dramatically, especially in terms of these import costs for chemicals and plastics are rising. And we also see inflation in transportation costs. These things represent significant opportunities for Mexico because of the proximity. In the face of rising transportation costs, Mexico's proximity offers it another significant comparative advantage. So what should we do? What is kind of my vision for how we should proceed or take advantage of this opportunity? I'm going to propose what's known as the flying geese model. Asia followed this flying geese model to much success, where Japan was kind of the leader in this industrial development, but they actually spearheaded and promoted the economic development of local trading partners by gradually facilitating the production technology transfers to other countries. And the reason why this is a flying geese model is in the East Asian context, Japan was this lead goose, and they were able to facilitate economic development by basically offshoring the less sophisticated technological advanced production and production techniques to other countries. And then those countries, as they developed and they adopted new technologies, would move those technologies into other regions. So we've already seen, and when I was down in Nicaragua, I've already seen this, that Mexico is already facilitating this kind of production technology transfer to Central America. So I think it's time for us to think about Texas, Mexico, and Central America in a longer run, more proactive effort to allow economic growth and facilitate economic growth to mitigate some of these pressing social problems. And obviously this is not about our pressing social problems, but I was in a meeting immediately before this one in which someone raised the question, of course, about migration on the border. And the Biden administration has released a plan for trying to reduce the Central American emigration by promoting economic development in Central America. And my point is that Mexico needs to be a key partner in that by also taking the lead and investing in technology and that sort of thing by following the sort of flying geese model. And that's going to be a way that we can work together as a North American region to address migration and some of these other concerns through economic growth and development. So that's where I'd like to leave. Thank you very much for the time, and I'm very much looking forward to Fernando's comments and the conversation. Thank you.
Thank you, Raymond. Very impressive presentation. And I actually love the concept of the flying geese model, right? And I'm actually going to anchor my comments on that proposition, because that is exactly the type of model that I think we should pursue in the near future. One of the things that Luisa didn't mention when she was presenting me is that I'm also the chair of the U.S.-Mexico Association, and this is the largest association of Mexican business people in the United States, right? And last Tuesday, just a few days back, we had a very important event called the Texas-Mexico Business Leadership Forum, and we convened some of the top business people in Texas and Mexico to talk just about this, right? So this is not only kind of an academic analysis. This is actually what the business people are seeing as a great, great opportunity. How can we create a partnership between Texas and Mexico in the context of two big things that we see happening, right? One is, as we are all aware, the USMCA, the NAFTA 2.0 version of our trade agreement is already in place, right, as of last summer. And there are two big things that happened in the USMCA, and I was fortunately part of the team that was very much involved in pushing for this. And it's the growth in scope of the USMCA versus NAFTA, right? And this is something that people don't talk enough about, but as we're all aware, in the new agreement, there are new chapters, and I will just emphasize two new chapters that are incredibly relevant to our discussion. One is the energy sector, and the other one is the technology sector, right? The digital trade and digital goods chapter. And I think this is very, very important in the context of what we're discussing today, kind of this flying goose model, right? The second big thing that has happened, and Raymond, you talked about this, about the trade war between China and the U.S., and I would like to kind of expand that into kind of the geopolitical confrontation that goes beyond trade, right? Because I think trade is just one manifestation of a larger narrative that's happening, which is a geopolitical confrontation that happens on the trade front, but certainly also on the technology front, and on the security and defense front, right? And all of these things are intertwined. And what we see is that the Biden administration has very clearly indicated that beyond the tariffs that are still in place, right, and most likely will continue in place, but on top of that, there are certain strategic industries, right, that are critical in this geopolitical confrontation, right? And obviously, the most visible one right now is the semiconductors, right? Because of the pain that the automotive and technology sectors in the U.S. are suffering because of its dependence on Asia, but also other sectors, right? The biotechnology sector, certainly the pharma sector, the critical materials that you mentioned, right? Both for producing electric batteries and for producing semiconductors. And I can go on and on, right? But these are very clearly identified. So I think these two big shifts, right? The ratification of USMCA and the amplification of its scope and the geopolitical confrontation between China makes it essential, right? Not only kind of an opportune thing, but actually essential for Texas and Mexico and the U.S. in general and Mexico to work together. But I think kind of the particular partnership between Texas and Mexico is very, 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 very relevant, right? So I think what we already see is some discussions and some things that are actually happening in terms of this shift, right? So I'll give just a very, very concrete example of something that is happening as we speak. So in the semiconductors, right, we know that a lot of new fabs are going to be built in North America. There's certainly an opportunity to build some fabs in Mexico. But if you think about the supply chain of semiconductors, right, the value chain of that is just infinite, right? So it would be great for Mexico to secure some of those fabs in Mexican territory. But even if we don't, right, it is essential for us to work together in integrating the supply chain that would facilitate that successful strategy of reshoring the semiconductor industry. On the automotive sector, that has been a huge driver of trade between Mexico and the US, right? And we know that when we see that tremendous growth that NAFTA brought, it's mostly on the shoulders of the automotive sector. Well, on the automotive sector, we're seeing a great shift, right, in electrification, right? So how do we reconfigure the supply chain of the automotive sector with taking into consideration this technological shift towards electrification that brings together two topics of the USMCA, right, which is kind of digital and energy, right? So that's another opportunity to collaborate. Certainly in the biotech, right now trade between Mexico and the US, for instance, on pharmaceuticals is very, very small, right? And the dependence on Asia for pharmaceuticals is just fantastic. There's a lot of manufacturing happening there, and actually Mexico could be a great manufacturing hub. US is developing the technology and the innovations, and we see this with the vaccines, right? With the COVID vaccines, just the wonders that the Modernas of this world have created is fantastic, right? There are great technological platforms in the US for technological innovation in biopharma. The manufacturing, I think Mexico has a huge role, right? And that can be kind of another engine of growth in our relationship, right? Certainly in aerospace, right? We see that both from an economic perspective and also from a geopolitical perspective, it makes sense to consolidate our aerospace industry. And an area that Mexico has not participated in the past, but it could participate not only in relation to aerospace, but also in other verticals, is certainly the defense industry, right? Mexico has not been part of the defense industrial complex, right? And Mexico has a perfect role to play in that space. And there are other sectors, right, that I think with the conjunction of the expansion of the scope of USMCA and the geopolitical priorities for having in North America certain strategic industries, there's certainly a great role to play, right? So we believe, right, that in the AEM, we've been discussing it with our partners, business partners in Mexico and in Texas, of a concept that we call 1T30, right? And the aspiration of 1T30 is to expand the economic relationship between the US and Mexico to $1 trillion by 2030, right? That would basically mean double the amount of trade and economic activity that happens between the two economies in the next 10 years. And if you see the trend of growth between the US and Mexico, right, it's perfectly achievable. And I think it's going to be on the shoulders of these new sectors, these new industries, right, which is pretty consistent with what you were saying, Raymond, which is not the low labor, right, low cost production, but it's really more in integrating ourselves into what's called the fourth industrial revolution, right, that is very, very rapidly expanding. So I'll stop there. I'll just make one comment or a question, Raymond, to your analysis, which I'm very curious about, which is kind of the role of exchange rates in the U.S.-Mexico trade, right? Because in the spike of trade that you showed us, right, obviously there's this substitution effect based on relative tariffs between Mexico and the U.S., but also as Trump was inaugurated, there was a huge devaluation, right, of the Mexican peso vis-a-vis the dollar. And I'm just curious to I don't know the answer, right? But my intuition is that maybe that also played a role in making Mexican exports more competitive, right? Because there was no structural reason, right, of that devaluation, right? It was based on expectations, right? So all of a sudden, Mexican exports they're cheap, right? And maybe that also propelled some of that export boom in those years. I'm just curious. I don't have the data, but I'm curious to hear your thoughts about the role of exchange rate in that trend.
Yeah, thank you. I didn't want to interrupt you, because I was so enthralled with what you were saying. I thought I agree with you across the board, and it's really exciting to see that academia and the business community are actually so in sync. You know what I mean? Like, how often does that happen? And so it's really exciting to see that confirmation, and I think really speaks to the importance of the work that the Texas Mexico Center does, right, in promoting these kinds of events. So I want to thank them again. Just, on the exchange rate issue, I agree with you 100%, because I remember kind of joking with my students about how the Trump rhetoric really originally was focused very much on the trade deficit with Mexico. And they said, we need to really impose these barriers in order to deal with the trade deficit, which then created anxiety, which then created devaluation of the peso, which then led to an increase in Mexican exports to the United States. So it had exactly the opposite effect of what he was hoping for at the beginning. So I enjoyed the irony of that very much. But yeah. So I really appreciate your comments, and I hope that there's a way that we can continue to work together, right, to try and take the lessons from academia and apply them in business. That sounds great.
Absolutely, and thinking on policy recommendations, right? And how can the private sector of Texas and the private sector of Mexico collaborate to make this a reality, right? Because if we are now forward-looking instead of backward-looking, right? Not only explaining what happened, but kind of trying to influence what might happen in the future. I think obviously there are great opportunities in the energy sector, right, based on the USMCA, but we see some very serious setbacks in terms of what's happening in terms of public policy and legislation in Mexico. So how can we address that to capture that opportunity? And we change it from a theoretical opportunity to a real growth opportunity. And I think the same happens in other opportunities, right? So for instance, as the Biden administration has launched a 100-day task force, and I'm sure you know this well, right? A 100-day task force for recommendations how we can, how can the U.S. Reposition itself in certain industries, semiconductor being one of them. I think it's critical to see how can we insert ourselves into that conversation. See, listen, Texas and Mexico can play this role in the semiconductor sector, and Mexico and Texas can play this role in the minerals, the rare minerals sector, right? And Mexico and the U.S. can play this role in the AI technology development sector, and so on and so forth, right? So I think it's very opportune, right? And I think the Biden administration has been very, very clear on its priorities. And now I think it's upon us to try to work with those priorities and develop both public policy recommendations, but also private sector partnerships, right? That actually turn that into a reality.
Yeah, I think that the Texas Mexico Center and obviously the other organizations really have an imperative to convene stakeholders to form that common voice. Because I think you're right, that academia, I think, is talking about the benefits of Texas-Mexico integration. You're talking about the benefits of Texas-Mexico integration, but I don't think that either Mexico City or DC fully gets it. I don't think they really understand the potential quite yet. And I think it's on us in a way, right, to really try to convene the stakeholders, get the word out there, and do as much as we can to promote the potential, which is tremendous, for expanding the Texas-Mexico and the US-Mexico relationship. Absolutely.
Absolutely.
Gentlemen, I couldn't agree more. You're absolutely right. That is the imperative of the Texas Mexico Center, to bring all your brilliance and policy recommendation into the arena of Congress to be considered. So with that, we're going to jump into questions. With that, telling ourselves how great we are, I'm going to jump into questions. Jenny was telling me something. I couldn't hear her, but The camera, no, yes. I did not want to be on camera. I just want my voice to be echoey for all. So we're going to start with talking about policy and something that was a policy discussion for previous administrations. It's something our colleague, Dr. Hiroki Takeuchi, is asking about CPTPP now. Is this a time to consider expanding our trade agreements, even USMCA, to include some Central American countries? As you both said, it's so important in the policy discussion to consider Central America. And he asked specifically about Costa Rica. So if you all can talk about this very specific piece of policy discussion, trade agreements, should we expand? Where are we now?
Um,
I'm happy to answer or to give an answer, but Raymond, so negotiating trade agreements is hard, right? It's super hard, and it takes time, and we often forget that without the follow-up of the private sector actually investing and doing things, it's just a piece of paper, right? And this is my particular view. Mexico has signed more trade agreements than probably any other country in the world. Still, our trade is dominated by the U.S.-Mexico relationship, right? I mean, most of our trade goes into the U.S. and right, and we have great agreements with Europe, and we have great agreements with South America, and we have great agreements with Central America. So, my point is, I think right now there are enough agreements in place, at least between Mexico and Central America, and Mexico and South America, to really, at least at the first derivative, right, achieve the objectives of what Raymond was suggesting, right, as the flying goose model, right? Mexico has a trade agreement with Central America. The U.S. doesn't, right? But if we follow this trickle down logic that Raymond was following, I don't think I mean, it would be great to expand, right? But I don't think that's the bottleneck, right? I think the real bottleneck is finding the real economic drivers that make that investment and that trade a reality, right? In the end, business people make decisions on return on investment, and it needs to make economic sense to actually do certain things, right? Whether there's a trade agreement or there's not a trade agreement. So I don't see too much friction in trade between. I don't see that as a bottleneck, honestly, as a business person. I mean, you might have a different opinion, Raymond, but I think right now the institutional framework that exists allows for so much growth in investment and trade that I don't necessarily see that as a bottleneck.
Well, yeah, just to add on to that, I'm a fan of trade agreements. I appreciate that they are difficult, but one of the things that economists or economics teaches us is that people respond to incentives. And the research coming, following the trade research on trade agreements is that people respond to these incentives, and trade agreements establish incentives. So there's been a lot of examples, whether it's in AGOA or Bangladesh or even in Central America, where the provisions within trade agreements actually do shape those returns and alter business behavior. So the problem has been is that when we're shaping these kinds of agreements, whether it's extending the TPP or the USMCA or whatever, what are our precise goals? What are the incentives that need to be changed? How do we increase those returns to business investment in Central America in order to induce expansion of investment? And for example, what's the issue with financing, right? So financing in Central America has also been an impediment to entrepreneurship at the smaller level in Central America. Can we find a way to use trade agreements to alter access to finance or promotion of localized finance? So I think there are a lot of things that we could do if we're very mindful, and obviously in promoting kind of free trade, but using those economic incentives to promote private sector investment and economic growth. That's my thought.
I would agree with that. And I guess my point is, oftentimes government negotiate trade agreements without asking the private sector. So they're solving what I would call a non-existent problem, right? So they're kind of negotiating things in a vacuum oftentimes. So for the incentive, for the trade agreements to be effective, right, and to really shape behavior, you need to solve a bottleneck. You need to really solve a real problem, right? So, for instance, I would argue that the real problem right now for investment in some Central American countries, it's not the case of Costa Rica, but it's the case of others, is just the violence, the availability of skilled labor, right, and others, right, infrastructure in general, right, and you don't solve that necessarily with a trade agreement, right. It's the same with Mexico and the U.S., right. I think the what's happening right now in the energy sector, right? There's no investment flowing, even though we have a great trade agreement, the USMCA, and it's not flowing because of the insecurity of certain kind of the question of whether the rule of law will apply, and will the change of the game be changed, or the rules of the game be changed, and what's happening in the electricity sector. So even though in theory the incentives are there, right, investment is not flowing because the bottleneck is elsewhere, right? So I think if we really want to make this kind of flying goose model, which I love, right? I have never heard about this analogy, right? But if we really want to follow this model, we need to be very, very specific in terms of identifying the bottlenecks and solving them, right? And trade agreements are just one piece of the puzzle. I think right now the bottlenecks are elsewhere, not necessarily. I don't think the kind of the necessary tool right now is more trade agreements. I think we need to focus on what are the bottlenecks and really solve them.
Yeah, and I agree with you completely, right? There are a number of other challenges which are unfortunately outside the scope of our traditional trade agreements for sure. But some of the trade agreements, right, might also, create a differential incentive from the outshoring from China, right? So you're saying that we might suddenly face some sort of adventure where people are trying to think about Vietnam, as in the chat, someone's comparing Vietnam and Mexico. Is there some other kind of lever that might change that balance? But you're right, I agree with you completely on those underlying bottlenecks. And if we can find a way to kind of put pressure where it needs to be applied, that we'd be successful at that point.
Yeah, absolutely.
Raymond, you mentioned some of the questions in the chat, so I want to pick up a couple of those. One of them, as you highlighted, is about both Mexico and Vietnam as alternate sites for this adaptable production base. So I'd love to hear more if you have comments on that. And then there is, I'll let you all framework. There's another question on this, on the geese model and the goose model that's being very popular in light of China's growth. Is the model still possible?
Yeah, starting on the Vietnam, I think one of the things that we've noticed about Vietnam is that they are really climbing this technological sophistication ladder quickly. They're following the example of China, but they right now are still very much focused on apparel. And they're moving quickly into footwear, and they're moving into electronics. They're moving quickly, like China followed the same common path. But Mexico still has a head start. And so the point of my opening comments was that we need to think about Mexico differently. And exactly as Fernando was saying, is that let's think about the advanced stages of the production chains, the more capital intensive, technology intensive. Mexico's ready to take those on. Vietnam isn't quite there yet. So obviously it depends a lot on the industry, but depending on where you are in the value chain, that would make a difference. But I also think that the distance is another big deal, the distance and language. I mean, obviously Spanish is the second language of the United States. I mean, obviously we have lots and lots of people in the United States who speak Spanish, probably a lot more than we have and speak Vietnamese. So in terms of, kind of developing vertical integration, Mexico still has tremendous advantages over Vietnam. And then on the other one about the Chinese economic growth, is the flying goose model still possible? And I would say, sure. I mean, if you go down, Nicaragua, if you Guatemala, there's still, we have the complete labor skill distribution in North America. And that is the point of what you need to make the flying geese model work. That and intent and deliberate intent. So those things are together. So in North America, we have that entire package. The fact that Mexico has sort of filled in this upper middle part makes it even that much more complete, right? So we have sort of the labor abundant areas still farther to the south, even including maybe Chiapas and Oaxaca, if you'd allow me to say that, and then all the way into Central America. So I think we still have the range. The thing that we're missing now, like I said, is just the political intent.
Yeah. And one of the things I would say from a strategic perspective, and at least from a private sector, that this is how we view it, right? I think what NAFTA created and USMCA can solidify is a shift of mindset, right? Because, in NAFTA, kind of the whole objective was to increase the sale of goods to each other, right? We were trying to amplify trade within the region, right? So the key metric, the key success factor, right, the KPI was how much is Mexico exporting to the US and how much is the US exporting to Mexico. And the same with Canada, right? I know there's a question here about what about Canada, right? And I'm happy to address that as well, right? But that was the mindset. Now, the reality is that the new mindset in USMCA and both the Mexican and the US private sector have this very, very much in mind is it is not so much now how much we sell to each other, but how much can we collaborate to sell to the rest of the world, right? So it's starting to really gel the idea of an economic trading bloc, right? And that's a huge competitive advantage vis-a-vis Vietnam, because Vietnam will never have that, right? So again, from a geopolitical perspective, from a deep economic integration perspective, right? It's okay, right? How do we become, as a region, hyper competitive against other regions, right? And what we see now, and this is a reality, right? And I'm just going to mention three companies, right? Three Mexican companies that are a great example of this, right? You have Maseca, you have Bimbo, you have Cemex, right? And you have others. You have Nemac, and right? You have many others. These are now corporations that are based in Mexico that have a very, very strong North American presence, right? Most of the bread we eat here in the US, right? It's produced by Bimbo, right? Whether it's Oro Wheat brand or whatever other brand, right? It's just a marketing gimmick. We're really buying Bimbo's bread, right? All across the US, right? And now the question is, okay, this North American entity, right, becomes now a powerhouse of bread production around the world, right? And that's the model. It's the same with, for instance, Cemex, right? I cannot picture another company benefiting more from the $2 trillion infrastructure announcement that the Biden administration made that Cemex, right? I'm rushing to buy shares of Cemex, right? Because the cement that's going to go in those bridges, right? And those dams and those trains and whatever is going to be Cemex's cement, right? So I think when we think about the integration, right, and the collaboration between Texas and Mexico and the U.S. and Mexico, it really comes now from a new mindset, which is how can we make the region and the companies that are in the region the most competitive in the world vis-a-vis other regions, right? And I think that's a mindset that is becoming more and more prevalent, right? It's not about a company or a product; it's about a supply chain and the competitiveness of the supply chain in the region vis-a-vis other regions, right? And I think that's a real mindset shift that really leaves other countries in a relative disadvantage vis-a-vis Mexico, right? Because of that sense of being one economic bloc.
Yeah, and just to send a little shout out to Jim Hollyfield, is one of the people I respect most in the world, asking. He's got 2 questions in there, and hardly anybody is more wise than Jim. But Canada obviously is really important in there. We don't talk about them as much because we're in Texas. If we were in Minnesota, for example, we might be talking more about them. But we don't want to leave them out either intentionally or unintentionally, because they're a critical partner. But in terms of your other point about is there an emerging North American comparative advantage, I think what Fernando was just describing was right on. That there definitely, I think, is there is sort of an emerging North American competitive advantage, but it's not fully realized yet, and it's going to take a lot of discussion, influence, these types of stakeholder events, and pressure on our government officials to find that common ground and shape the incentives necessary in order to fully realize the potential. If I may, I'd like to refer you. I did a report with the World Bank called Better Neighbors, which talked exactly about the phenomenon that Fernando was saying, right? Is that this type of localized practice for exports helps make you globally competitive. And we did that analysis for Latin America, but I think we could do the same thing for North America, right, in particular. And so I wanted to, highlight that and say I agree with you, Fernando, again. Surprisingly, we're on the exact same page again. So thank you very much for that point.
Just adding a little kind of spice to that comment that you just mentioned, right? If you think about artificial intelligence, right, the flying goose model actually flows from Toronto southwards, right? It was Toronto that was the pioneer in developing the newer methods of machine learning that are now commonplace everywhere, right? So if you think about the geopolitical and economic confrontation around artificial intelligence, right? You really see the innovation happening in Toronto, and Toronto being a huge hub for this, right? Then you have the mainstream production of AI in the US, and then Mexico is inserting itself into that value chain, right? So that's huge. In the rare materials, the Canadians have more mining experience than, right? Anybody in the world, right? So I do see a partnership of Canadian expertise, really tapping on rare mineral resources that are present in Mexico, and obviously the batteries are going to be built and bought here for their electric cars and others, right? But I think, yeah, certainly the Canadians have a huge role to play, and we should leverage that as an advantage, right?
Gentlemen, I know we could speak forever on these topics, and we are just so grateful at the Texas Mexico Center to have such distinguished speakers. This has been recorded and will be available for people to join and listen to your point and discussion points. So I want to thank you both for being so generous for your time. I want to thank the audience for joining us, for sending so many questions. Feel free to reach out to us if you have follow-up questions, SMU, Texas Mexico Center. And lastly, I want to close just by, I think the 2 gentlemen here, Jenny, my colleague, but we would not be here without Mission Foods. I want to thank Mission Foods and their leadership in establishing our center that looks to be really that bridge between the academic world and the policy world on the most dynamic relationship in North America, which is Texas and Mexico. So with that, we are adjourned in our seminar, and I hope you'll join us next week for the next installment of our series. We're going to be talking about the border and human capital and education between Texas and Mexico. Thank you, everybody, and have a great Friday afternoon.
Thank you.
A real pleasure. Thank you. Such an honor, Fernando. Thank you. That was outstanding.
That was a great conversation.